Okay, so what we're going to be talking about over the next couple of weeks or so is the budgeting process. And this PowerPoint presentation in total will be broken down into about 5 or 6 parts. So this is part 1. We've got some learning objectives up on the screen, and looks like for this particular, eventually we're going to get through all 5 of these, but for this particular presentation, we're going to get through objective 1, and then we're going to get into objective 2. Okay, and we're going to actually do most of objective 2. We're going to save the master budget for the next presentation. So this class is designed for marketing and management majors, and I think that you can appreciate the core fundamental steps of budgeting. We have the 3 E's on the screen: establishing goals, executing plans, and then evaluating actual results with those goals. So this budgeting process is very, very similar to your strategic planning and your action plans that you have hopefully studied in other courses. All right, so this should actually be somewhat old hat for you. However, when we talk about establishing goals, executing decisions, and evaluating results, we are going to break that down into 3 other components of the budgeting process, and those components are planning, directing, and controlling. And specifically this last example here, this controlling aspect, has a bit more of an accounting flavor to it. Okay, and so even though we're talking about this budgeting concept from an internal management perspective, we do need to understand that our planning and establishment of goals, our directing and executing of the decisions that are a part of our plan, and all of these things are ultimately going to show up in the financial statements, and the financial statements are intended for external users or outside entities rather than those within the organization, such as strategic planners, managers, that sort of thing. Okay, so we need to kind of make this connection between planning and establishing, directing and executing, and controlling and evaluating. All right? So before we get too much into the nuts and bolts of the budgeting process, we do need to understand that there's a saying, be careful what you wish for because you just might get it. And so when we talk about budgets, we are talking about a plan. We are talking about goals for the company, much in the same sense that you have studied these concepts in other non-accounting type classes. All right, but we have some problems that are inevitable when it comes to budgeting, and they involve the human element, very, very much so. And so when we go through these, we have sometimes goals that are set too tight, and these goals can be very, very demoralizing for the members of a team and in fact for a company as a whole. A good example of goals that are set too tight are whenever a corporate structure is very, very top heavy. We have a very, very centralized form of management, and there's a lack of communication between top levels of management and on-ground line-specific management teams. The communication is essentially, this is what we've decided are the goals, and you are going to do them. And sometimes when we have a highly centralized type of corporate structure, there's not a lot of communication going on back and forth. These goals are simply not very realistic, and you can just about assume that they're always going to be very, very aggressive goals, and that's fine. That's fine. We always want to be on a path of moving forward and continuous improvement and so forth. However, when our goals become unrealistic, it can be a problem. And eventually, we go from a workforce that says, okay, this is going to be tough, but let's give it a try, to a workforce that says, we have no chance of making these goals, so why bother even trying? And that's what we do not want to have happen. Okay. Conversely, we also have this concept of budgetary slack, and this happens when goals are set too loose and they're very, very easy to achieve. This second particular issue is a common problem that we see in decentralized corporate structures, where lower level on-ground managers are allowed to have too much input into their department's goals. So put yourself out there, and I'll just ask you, would you rather make a goal for yourself, if your job depended on it, that is? Would you have a goal for yourself that you knew for a fact that you could obtain, or that you could achieve? Or would you set a goal which was going to be very, very difficult for you to achieve? And oh, by the way, if you don't achieve it, you might lose your job. So this is a problem as well, because yes, we've met our goals, but we haven't really optimized company resources. We have not optimized shareholder wealth and growth, right? And then finally, we have some self-interest issues, and here we're getting into ideas such as income smoothing and so forth. I worked at a company one time that the idea of behind the monthly budget was we want to make budget every single month, but we don't want to make budget by too much, because our monthly bonuses don't necessarily go up in proportion to how much we blow this goal out of the water. And there was an idea that we wanted to make budget by at least $1 every month. That way everybody got their bonuses, and we would kind of, the idea was to kind of hold back on some revenue recognition and so forth until the next month, so that we had a head start on the next month. Now, I will tell you, I didn't get any of those bonuses, so that didn't pertain to me. I was in the accounting department. But some of the higher ups definitely had that as a strategy, and that would be considered a self-interest conflict. All right? Okay, so we want to understand that when we talk about a budget, most of the time, businesses are going to operate on a 12-month period, 12-month cycle. In fact, they always will. I guess what I should have said is most of the time they're going to operate on a 12-month cycle that starts with January 1 and ends December 31. All right? However, if we think about that, there's a bit of an issue there, and that is that we move through this process as we move through the fiscal year, this 12-month fiscal year that we have here. We need to kind of know if we are ahead of the game, if we're behind the yardstick, so to speak. We need to have that information well before December the 31st. Again, assuming a January 1 through December 31st year. It doesn't help us any if we find out at the end of the year that we have been doing poorly and all of the goals that we put forth at the beginning of the year are not going to happen. So your slide says here, we normally will take budgets and we will subdivide these into shorter periods, such as quarterly goals, monthly goals, and weekly goals. And it might be intuitive for you to realize, and you probably do on some level, that the longer the period of time that we're looking at, the more estimation we're going to be using. So a weekly goal should be far more accurate than a monthly goal, and a monthly goal should be more accurate than a quarterly goal. So, but at the same time, the quarterly goal is hopefully going to be accurate, and it's going to give us data for 3 months, whereas the most accurate budget is only giving us information for 1 week. All right? So we have some other tools to help us with this budgeting process. And one tool that is very, very effective and is used in most industries by all of the top businesses is this concept of continuous budgeting. And continuous budgeting is essentially a rolling budget. So we have our weekly budgets, we have our monthly budgets, we have our quarterly budgets, but we always have a 12-month budget in front of us. Okay? If we didn't do continuous budgeting, we would only have a 12-month budget, say, for example, a calendar year business on January the 1st. And then on December the 15th, for example, we would only have about 2 weeks left for our budget. So, continuous budgeting does a couple of things. It gives us, whether we're in the month of January, the month of April, the month of September, it gives us a 12-month budget, a 12-month view of what our landscape, what our plan looks like for the business. Okay? And it's also very, very important because trends change, and we're going to get into a little bit more detail on that in a moment. Okay? But continuous budgeting is a continuous 12-month projection. So if we're in February, we have the month of February, and then we have 11 more months after that. When February is over, it drops off. We pick up with March, and we have another 12 months going forward, and so forth. All right. So we also have some other concepts that we should probably discuss. We have what's called zero-based budgeting. And zero-based budgeting is not something that you're going to see very often. However, it can be particularly useful in situations where a business has completely changed their primary mode of business, or if environmental factors have completely shifted the landscape. for the industry in which a business operates. And so it says zero-based budgeting requires managers to estimate sales as though we're starting over for the very, very first time. What we're implying here with this concept is that historical data is really not as useful as maybe it has been in the past to us. So in rare situations, we will use this concept of zero-based budgeting. Your slide also says a much more common approach, 99.9% of the time, in fact, is to use a process of both static and flexible budgets. Okay, and let's get into that now. So a static budget is more, this is kind of an old school approach. We come up with a plan in the latter part of a year. If it's a calendar year business, we come up with a plan, say in November and December for the upcoming year, January through December, and that is our budget, and we break it down on a monthly basis, a quarterly basis, whatever the case may be, accounting for seasonal changes and so forth. And at the end of the year, we assess our results. But the world moves very, very fast. Industries change for good and bad all the time. And so this type of budget has major disadvantages. And that is that it's simply, because it is a static budget that is made and then we go with it, it is incapable of accounting for changes in the marketplace that will lead to changes in our production, our expenses, and our sales as a company. So far more important is this idea of a flexible budget. And really what a flexible budget is, in effect it says, is a series of static budgets for different levels of activity. So we might have 2 levels of activity in a flexible budget. We may have 3 levels, 4 levels, so forth. It depends on the level of uncertainty that we have in our industry. So when we are going to put together a flexible budget, we have 3 steps that we have to follow. And the first thing is we need to determine relevant levels of activity. We can express these in units, machine hours, direct labor hours. It all depends on the nature of our business. Maybe we're in an industry that is very labor intensive. Maybe we have an industry that is more mechanized, and human labor is not a major cost driver, okay? The second step you should be very familiar with. We're going to need to identify fixed and variable cost components. Otherwise, if we don't do this, it doesn't matter what type of budget we have, we're not going to be able to establish our cost. And then finally, because we are talking about a flexible budget, we're going to prepare our variable costs using these changes in anticipated activity levels. Okay, and we've got an example of that coming up, I believe, on the next slide that may make step 3 hopefully a little bit clearer. And we do. So we've got this company and we're looking at the assembly department, and we have levels 1, 2, and 3, okay? And it looks like what we're doing here is we're starting with units of production, and that makes sense because what we're trying to determine here ultimately is total department cost for the assembly department. So here we have 3 levels. We could have 4, we could have 5, we could have 2. I do want to point out one thing. We need to understand that there's an assumption here regarding relevant range. And the assumption is that whether we're in level 1, 2, or 3, we're all within the same relevant range. If you don't believe me, you can look down here at fixed costs and notice that fixed costs do not change. If we have a situation where we have tremendous uncertainty, and instead of having 3 levels, we have, say, for example, 20 different production levels, then I want you to understand we're probably going to run into some relevant range issues, and these fixed costs may not remain the same, okay? But for our purposes, we're going to assume that all 3 of these levels are within the same relevant range. We have level 1, which has 8,000 units of production, level 2, 9, and level 3, 10,000. We've been able to establish a direct labor cost per unit, as well as the utilities component of factory overhead. So it looks like our variable cost per unit is $5.50. Let's just see here. So if we were to take 8,000 units and we were to multiply that by 550, we would in fact come up with $44,000. So you see the variable cost component of production goes up, as does the number of units produced. That is not the same case here with fixed costs. Everything remains the same. Supervisor salaries are going to be the same at all 3 levels of production. Total department costs go up in direct proportion to the variable costs. And we have here, this will be the last slide for this presentation. We have a comparison of the use of static and flexible budgets. Over here on the left, we have a static budget. The static budget appears to be for 8,000 units. Where did I get that? 8,000 units, total department cost $60,000. But what ended up happening, as I'm looking at this, is our static budget was for 8,000 units of production, but we actually produced 10,000 units. Therefore, it looks like we've gone over budget in terms of our cost by almost $11,000. Well, sure we did, because our production increased by 25%. Our cost should go up. Over here, however, on the flexible budget, we compare actual results to the appropriate level of production. In this case, 10,000 units. We budgeted $71,000 for 10,000 units. Let's go back briefly. See, 10,000 units, total cost of $71,000. But our actual results were $70,800, so we were actually under budget by $200. Now, so the static budget shows that we're way over budget. I do want to point out that that's for this example. We could have just as easily had our static budget based on 10,000 units of production, and then let's say that market forces changed and we only made 8,000 units. Well, now a static budget is going to show us, instead of being over budget, that we're under budget. Well, sure, we're under budget because we made 20% less. Okay, so the moral of the story is flexible budgets far more useful than a single static budget. At this time, you should have all of the information that you need to answer all of the questions on your first handout for these chapters 7 and 8. If you have any questions, let me know.